Hey everyone, and welcome to another episode of the ProVenture Podcast, the show where we talk about real estate, business, and everything in between. I'm your host, Giancarlo Carangelo, and today I'm actually joined by Lane Kawaoka, who is an author and a real estate investor. And he's agreed to come on the show to share us a little bit about his journey and who he is, where he came from, and how he got here. So, Lane, thanks for sitting down with me this
Yeah.
evening.
Yeah. Thanks for having me. Hello, everybody.
So, give us the listeners a little bit of a backstory, like who you are, where you came from, and what exactly it is that you do. Because I saw your resume and it's quite impressive. So let us know who you are.
Yeah. So today, I wrote the book, The Wealth Elevator, which is pretty popular on Amazon. I operate a private equity company. We syndicate apartments and we buy businesses. We've done over $2 billion of past real estate deals. But it didn't always start that way. Back in 2009, I was working at my engineering job, which I didn't really care for. And I bought a house to live in because, like a lot of people were taught to go to school, do the 401k, work that job. And I realized wow, if I could just rent this out, which I started to do shortly thereafter, I'd be able to escape the rat race as I started to pile more and more of these rental properties up.
Yeah.
So that was back in 2009. I bought that first property, bought another duplex in Seattle, and then a few years later, and then by 2015, I started to buy all these properties out of state in Birmingham, Atlanta, Indianapolis. So in 2015, I had 11 rental properties, and that was kind of where I got to that second level of the wealth elevator, as I kind of chronicle it in my the book Wealth Elevator.
Amazing. So let's take it back to when you were an engineer. That's a pretty impressive job title nonetheless, which I imagine requires some schooling and some education and everything. And a lot of people really strive academically to make something of themselves, right? Doctor, engineer, lawyer, architect. But you found yourself with that great, stable, secure title, but you wanted to break free. What was the whole thought process behind that mindset? Some people say it was the job, the redundancy, but for you, what was the whole process behind that mindset of, okay, I'm an engineer, but still I think there's more out there for me?
Yeah. The first thing was numbers, right? I got paid, 6 figures, but, if you follow the career progression of most of the people 10, 20, 30 years older, you're not going to get paid. You become an accredited investor eventually from an income standpoint, but multiple 6 figures wasn't a possibility for most engineers.
Right.
So, and then that, I was working for a pretty, I think it was a Fortune 50 company. So pretty high stress. I was a construction supervisor. And then, I remember one day, one of my ex-employees died on the job, not working under me, but he used to work for me. And it just seemed like nobody really cared. And it was this kind of corporate BS verbiage about it. And
that was on the job?
Yeah, something hit him. And we always kind of preach safety, right? But it's kind of it's a dangerous work, out there in construction. And what got to me was kind of my boss's boss, and boss never really cared. And it's just some corporate BS that they say, right? And I was like, as soon as I can not do this, I'm not going to be here. Was kind of where I was at, but the motivation was there, as I'm sure a lot of people don't really like their jobs. Engineers, I think, you work with a lot of numbers. You don't really see the benefits of your actions. Like doctors, when you heal somebody, it's people are so thankful right there, right? Because you help them get out of pain. But with engineers, it's very the opposite. So it was very much I have to just save my money and invest it. And eventually if I save enough and I invest well enough and I pay less taxes, I'll be able to escape the rat race and do what I want, where I want to, and on my own terms.
And, first of all, that story about that, that colleague, dying on the job, that I think really, because I preach this a lot to people, and not just people I work with, but friends, family, people who are employed. And, some people will go above and beyond for their corporate jobs or their 9-to-5s or anything, right? But I always say, if something happens to you tomorrow on the job site, your boss's business continues running with or without you, right? And that story is interesting because it could show how you could work 30 years, and then for it to not unfortunately mean anything if something were to happen to you like it did to your colleague, right? So I think that that's a great motivator for anyone, and to realize, right? Because I mean, it's got to be a shitty feeling, the family of the employee and everything. So, but, so take us to, there's so many directions we could go here. What led to you writing your first book? Like, did you start investing in real estate and then, have the idea, maybe I should write a book? Or was that something that was always in the back of your head before you started investing? Like, what led to that book?
Yeah, I mean, this is actually my second major book. The first one, so maybe I'll start so 2015, I had 11 rental properties, and then, a lot of people were asking me how I would buy all these rental properties, sight unseen, not even visit it. And then, just at that point, it got a lot easier because I had scale. Sure, I would have an eviction here or there, but with that many properties, you can kind of absorb the downs a little bit better. So I started in 2016, I started the podcast before a lot of podcasts started to get popular. And I built a little community and actually kind of coached a lot of folks and started a group coaching back then, how to do this. And what I realized is kind of like a repeatable system again and again, buying remote rental properties. Yeah. In fact, people, we give away this curriculum for free right now. I think it's at thewealthelevator.com/turnkey. But it was something that was like, hey, if like a young guy just buys a rental property and saves up more money to buy another 20% down payment, they'd be able to escape the rat race. Maybe not in 5 years, but in certainly like a decade, things compound on each other. And that was kind of where the idea of my first book, right, which was kind of going through buying remote rental properties. But about 2015, 16, I was going through a genesis of becoming more of an accredited investor. In my new book, The Wealth Elevator, I kind of talk about going from the first floor of the Wealth Elevator, where you're a non-accredited investor, buying little rental properties, and scaling up to being an accredited investor, investing as a passive investor into all kinds of deals, apartment deals, self-storage deals, private equity deals, venture capital deals, and diversifying and not being the general partner, not being the person on the front line of liability getting sued on this stuff, and allowing you to diversify into whatever geographic markets you're at. I was living in Seattle at the time. I had properties in a few areas. I had some diversification, but not the diversification you can get by being a syndication investor. So, everything I write about, I try to anchor it in experience that I have. And that was kind of my story. It was going from the first floor, non-accredited to accredited, second floor to the third floor, which is, you're an accredited investor, but there's a big difference between somebody who's $1.5 million net worth to 4, 5, 6 million plus net worth. There was never a book written out there for accredited investors detailing these types of thresholds and, third floor, fourth floor and beyond. Right. So that was kind of the motivation and the genesis to kind of writing The Wealth Elevator.
Right. And now, when it comes to your journey as an investor, give me some insight on there must have been a mindset shift when you went from investing in 10, 11 rental properties to becoming an accredited investor, working on larger deals, buying larger apartments. I mean, there has to be some sort of mindset shift behind that, I would imagine, correct?
Yeah, usually there's pain, right, in any decision. That pain point was, 2014, 15, I had 11 rental proproperties. I had, maybe an eviction or two a year, which is going to happen, right?
Yeah. Oh, yeah.
The funny thing is, from my track record, maybe I had maybe a dozen evictions, but 1 out of every 3 eviction ends up to be just a catastrophe. Like the tenant trashes your property, basically like a $10,000, $20,000 repair bill just to get the property back online. And you're like, what was I trying to do that all for? Like that was the profits for 3 rental properties for entire year right there, just poof up in smoke because some bonehead, just had ran into tough times and he decided to take it out on the property. For 11 properties at a few $100s of passive cash flow each, aggregated, of course, and averaged out, that's maybe $3,000 of passive income per month. Not bad, not going to complain, right? Yeah. Especially in the early days. But, most of my clients today aspire to $10,000, $20,000 per month. So they're going to need 3 or 5 times that many rentals. So what is that, 40 or 50 of these damn things.
Yeah.
And you quickly realize it's not scalable to own these things.
Smaller buildings. Like
yeah.
Yeah.
And then you also, people who've owned rental properties for a while understand that after 5, 10, certainly 15 years, there's this CapEx tidal wave that hits you, right? You got to start to repair the roof. You got to start to repair all these appliances. And it starts to eat into your seemingly profits that weren't really profits. It was profits plus unrealized liabilities, such as shit breaking all the time. So this coincided by chance. I started to interact with other accredited investors, people who had a net worth $1 million or greater that had done the little rental property thing. Maybe they flipped some houses back in the day, but they were all moving in the same general direction, which is getting out of the single family home ownership for less headache, but also getting away from the liability too, right? Because when your net worth goes over 1 million, you're a lot more, you're a lot more collectible at that point.
Yeah. And people want to collect at that point.
Yeah.
People,
I mean, you can sue for whatever.
They think you have the money, right? So they're like, they want to.
Yeah. You can sue for whatever. But I mean, if both sides want to waste money on lawyers, but you're not going to do it unless you can actually collect on something.
Yeah. Yeah, exactly. So, I mean, like, like when you were talking about reminds me of something I heard when it comes to real estate investing. There's two methods. There's the Walmart method and the Costco method. And the Walmart method being smaller storefronts, greater number of volume of locations, and the Costco method being larger stores and fewer locations. So it's kind of like when someone goes from investing in like, duplexes, triplexes, fourplexes, and then all of a sudden wants to invest in a unit with a building with 20 to 50 units, right? You're shifting investment methods. And I think that having, like you said, a few buildings, right? Let's say 10 buildings with 2 to 3 units each seems great on one hand and might be great to another investor. But from a management perspective, having one location with 30, 50, 40 units could be a lot easier to manage and a lot more feasible, right?
Yeah. And certainly when you get above 60 units, now you can have a full-time property management in there.
Yeah.
Not a residential property manager, which they're not that great, a commercial property manager. And then when you get above 100 units, now you can have full-time staff. So what that means is you don't get killed by all these third-party plumbers, HVAC guys, and you can actually get some things done on salary on your staff. So you're entirely right there. I'll add on top of that another layer of, with these syndicated deals, typically there's some type of business plan. Simply like as simple as like renovating units, right? Putting 5-10 grand into the unit and bumping the rents up because the unit is nicer. When I was buying these little rental properties, I was just doing the buy, hope, and pray strategy, where I was buying it turnkey. And that works when you're in a low interest environment. But, after 2022, or even I think after 2017, I don't think that strategy works because everything's so damn high in terms of price now that you have to go into assets and value add it. Now you can, if you're a smaller house flipper, you can do that. You can be consolidating all your risk in one thing, but you can do it. But if you're trying to diversify, the only way you're going to be able to do this and take advantage of value add is through a syndication that somebody else is a general partner on, that is, managing and pushing this project forward.
Right. Right. And it's so true what you say too, is like the larger buildings allow you to, in a way, not get killed by all these tradesmen, electricians and I know because as property manager, managing a few buildings, when I started off, a lot of them were smaller, right? Electricians were charging, at the time, 110 an hour, 105 an hour, 3 hours minimum. And that was like, even if they would come there and only work for 45 minutes, it would cost me $350 for 45 minutes of work. Whereas like having these larger buildings that allow you to have staff and maintenance guys on payroll and everything, you get that same basically repair done, but you don't even feel the impact at the end of the year because it's done on salary. Assuming that but then there's a flip side of that coin, right? Finding reliable, trustworthy people. I think that people, I don't know if you could agree or disagree, but people are like one of the most valuable resources in the real estate business, because for me, in my experience, finding good people are few and far between.
Right. And it needs to be a full-time job, which is why you should probably rely on not crappy small-time contracting companies or vendors. You need to go to bigger. And those guys only want to work with bigger apartment owners,
Yeah.
right? So there's this kind of, I was talking to one of my investors the other day, and he was kind of giving me the sob story on how they were, getting like a balcony back online and they had to follow permits and they didn't follow the directions. So like, well, that's what you get when you work with a little rinky dink contractor with a truck.
Yeah.
Right. When you work with
Yeah.
a larger contracting company, they have something to lose. And you just get better, more reliability. You may
Yeah.
pay just as much, but you get more reliability. And I think that's really what you're trying to go for. I mean, when I was a single family home investor, I mean, maybe this is a tip people can use if they still want to be scrappy and do it themselves. But the HVAC is always one of your biggest repairs. Also plumbing too, right?
Yeah.
But maybe go find your own plumber or HVAC guy who does those side jobs on the side. Like these are the type of bubble gum, masking tape tactics you have to do when you're a small time landlord to get
Yeah.
things done cheaper. But good luck if that's actually warranted work, right? When you're doing it that way. But, that's what you have to do when you're a small time landlord. But when you're a bigger guy, you have the money to pay for this better repairs, better staff. And that's, I think, what is the beauty of going with larger scale.
Yeah. And I think that the small, it's also a different, again, for me, I think it goes back to mindset, right? Like the smaller landlords, when they're looking at repairs, they're looking at, getting the repair done and saving a few dollars, right? Versus on a larger scale, you have expense, you have that expense, percentage allocated to maintenance and capex and all this sort of stuff, where at the end of the year, if you don't spend that money, you know what I mean? Like you're not taking advantage of tax strategies, right? Or you're not taking advantage of write-offs, or you're not taking advantage of something to maybe lower your tax bracket,
That's a big thing with these larger deals. I mean, with single family homes, I mean, I'm not giving any tax advice here. I mean, if people need referrals, let me know. But you can generally take 1/27th of the value of the building improvement and take it as a loss, which is the depreciation. But with these larger deals, you can often do a cost segregation and take advantage of bonus depreciation laws, not at 100%, where you can, like the first year could be like 10 times as much the first year. I mean, sometimes you can take 1/3 of the entire building's values as a loss the first year. And these are the kind of the strategies that funnel down to individual investors and can make a lot, they can take some of those passive losses and offset other passive income, add it in with a rep status strategy. And then now you're kind of expanding the pie here. Not only was this method of investing a lot more scalable, and now your ticket to getting to more institutional quality assets, but also tapping into value add strategies now where you don't have to actively manage it. But from a tax perspective, it's a stronger path forward.
Yeah. 100%, 100%. So what does the process look like when you're looking to put a deal together on a large building, with the investors, and what is that entire, walk us through that process, what that looks for? What do investors typically look for when, they're working with you? And what do you look for when you're working with an investor?
Yeah. So, I mean, whether it's us or anybody else, right? Like usually a deal gets presented to us, we'll take the P&Ls, the profit and loss statements, and the rent rolls.
Mhm.
You can typically see, like just buying a business, you can see how the run rate of the business works. We have our own proprietary spreadsheets that we use to model out the income, expenses, and the mortgages. Nothing special, nothing breathtaking, right? I'm sure a lot of these are floating around the internet. But I think when we look at the deal, the biggest thing that we're doing is we're kind of taking a look at what the operator, the sponsor, is assuming on certain factors. Like,
Right.
because if you change one factor more aggressive or more conservative, you can change the return projections very drastically at the end of the day. So you definitely don't want a deal to be underwritten very aggressively. And when you normalize it, it comes out to be not a great deal, right? From an ROI perspective. So like, I mean, one example of that is like, some of these operators think they can run an asset at 95% occupied. Normally speaking, I mean, it ranges for different markets. Like in Oklahoma, not the best market out there, you may want to assume that the property is running at, say, 89% full occupancy, whereas
Right.
Dallas might be 92%, for example, right?
Yeah.
So, that is one of the, dozens of things on the spreadsheet that we kind of go through and we spot check. And at the end of the day, you're just trying to source as many deals as possible and pick the best ones, but normalize them. All right. Because
Yeah.
everybody's using BS
Yeah.
assumptions left and right. If you
Yeah.
can somehow normalize it and pick the best one, that's really the name of the game. And you never know when you invest at the peak of the market cycle too. I think we
Yeah.
saw that in 2021 to 2023. I think as an investor, I mean, we take the approach of you're always just trying to dollar cost average, but doing it on a stoic approach where you're kind of taking a fresh deal and normalizing it against its competitors that are coming through that month or that quarter and picking the best one.
Yeah. Amazing. Amazing. So like the value add process, when you look at a deal, are you looking typically for something that you could definitely optimize? Is there a certain percentage that you're looking at? Like some investors say we typically try to buy, 65, 70 cents on the dollar to bring it up to 80 cents on the dollar with value add costs. Is there a specific percentage that you have that you follow, or is it basically case by case basis?
I mean, it's case by case. I mean, in commercial real estate, you don't really buy anything for something cents on the dollar. That's just marketing fluff.
Yeah.
The asset trades for a multiplier of what its net operating income is.
Yeah.
So you buy it based on the net operating income. The value add comes in after if you're able to increase the income or decrease the expenses, which is a lot more rare. Most times you're bumping the income up and improving the NOI that way. But you're buying, you underwrite the asset based on the net operating income. And then comes the business plan, as you said earlier.
Yeah.
So the business plan could be all kinds of things, but I mean, to use a standard example, if you're renovating the unit, putting 10 grand of improvements into each unit, bumping up the rent by $200, to bump the NOI 10%, that's the business plan. That's typically what we spot check. Sometimes they'll estimate it takes longer. Sometimes they estimate that the rent bumps are going to go a lot quicker, right? Like, I mean, like, for example, was looking at this last month was looking at like a low income conversion. So some properties that are built, they have like a low restriction on the rents, right? To kind of let low income people in. And then this is beneficial for the developer, right? They get all these sweet tax credits and everything. But sometimes, 10, 20 years go by, these restrictions burn off. And now you can bump it up to market rate, which could be $400, $500 higher than what it really is. In that case, I see a lot of these types of deals, which you don't really want to. I mean, they can underwrite it however they want, right? We're gonna underwrite it where we're gonna assume that it's gonna take them a couple of rounds to get them to that $500 increase because it's a huge amount, right?
Yeah, 100%.
You're not going to change the complexion of that tenant profile right away. So that's something that we apply is just a little bit more conservativeness to kind of make it more realistic in a way. Because anybody can underwrite whatever. I think that's where unsophisticated new investors get shiny object syndrome, where they see all these performers, but these performers don't mean anything at the end of the day. I mean, if you are an operator, you've done it yourself, you kind of have these understanding of how long a certain business plan takes, or, we've done so many deals in certain areas where we kind of know the pockets and like, that's not going to happen, right? We know that occupancy is not possible or those rents aren't possible because we own a property next door and this is the rents that we're getting, or we use a certain property manager and they know, right? So in commercial real estate, you have access to CoStar, which is institutional quality data, but still nothing replaces, you or your property manager owning a property in the same submarket as a data point.
Yeah. So, I mean, I think that's a very solid point to make, like you mentioned earlier. Let's say, the market dictates that you could bump up the rents $300-$400 a unit, whatever. Some people, I think they overlook that buffer period. It's not gonna. Sometimes it doesn't just happen from one day to the next, right? Where you bump up those rents $400, right? It might take a year, 2 years, 3 years, and that's an important part of the business plan. right? And like when people overlook that, it's kind of like they miss a factor, a very important factor when it comes into the business plan of it might take me 2 years. What they think they could do in a year, they think they could do in a year, realize that it actually will realistically take them 2 or 3 years, right? So I think I totally agree with you on that aspect. So like, let's ask some fun questions here. I imagine you invested in a few states. What's your favorite state to invest in?
I mean, I don't really care. I mean, most times we try to stay in the red states because
Yeah.
we're the landlords, right?
Yeah.
We have the landlord laws on our side. But lately we've been doing some blue states too because it depends on the deal,
Right.
right? Like if you can buy something at, like, in one project we've done, we bought it at $250 a square foot when the market's 500. Like,
Yeah.
I mean, there maybe in an extreme example, maybe I won't buy a property in like in Antarctica like that. But then again, if the market is at a certain rate, why not? Right? Like the numbers drive the deal.
Yeah.
But generally speaking, I mean, we go where job growth is and population growth. We tend to stick to workforce housing, which to me, my investment thesis is population is increasing. Maybe not for 30, 40, 50 years in the future, but right now in this era, population is increasing, especially in the lower middle class, right? The
Yeah.
people renting $800, $1,100 apartments.
Yeah.
So I like that thesis. I'm not a huge fan of office right now. But I like these types of investments that kind of follow the general macroeconomic trends out there.
Yeah. I think, office spaces, I'm from Montreal, and I could tell you that traditional commercial spaces and office spaces, especially during that famous COVID era, saw a huge rise in vacancy with the whole movement of, hybrid and remote work and everything, right? I think that they started to integrate it back, but that market definitely took a hit, that side of the commercial real estate market. But people always need a place to live. You know what I mean? And you could work from home, but you can't live at work, right? So people always need a place to live. And I think that, like I saw, especially here in Montreal, we saw the rental market just explode 2020, 2021, 2022. It was insane. Like we would put one of our units up for rent and we'd have maybe 20, 25 people come for a showing in the same day, And if there was one era that, like, if it was one thing that COVID era taught me is like, people definitely always going to need a place to live, right? Versus, the workspaces and some retail spaces and took a bit of a hit there. Do you manage any of these like commercial retail spaces, or do you have any of that in your buildings, or is it strictly just multifamily?
Mostly just multifamily. I mean,
Yeah.
most times it's a pure play on it. I mean, we have some of the storefront mixed use in the bottom, but I mean, it's negligible. When you
Yeah.
look at the whole total square footage. Yeah. I mean, at the end of the day, I mean, I think at some point as an operator, because we operate the apartments that
Yeah.
we go into, especially in Arizona, Texas, Florida, Alabama. As an operator, you have to kind of specialize. But I also invest in things where I'm not the operator too. So in those things, I'll be more inclined to spread out and do other things. Like, I mean, I have some exposure into office,
Yeah.
for example. Yeah, and definitely do agree with you that, people need a place to live as opposed to work. But it also depends on the supply demand dynamics.
Right.
If
Right.
they're not building any new office, fast forward 5, 10 years, then that'll come back, in
Yeah.
terms of rents. So that's the other part of the coin that you're looking at, right? You want to invest where the macroeconomics are, but you also need to know the supply demand dynamics that are here today.
The supply and demand dynamics that changes. Markets are always shifting. Markets are always shifting, and I imagine like state by state, every state must have its own, intricacies. I would
Yeah,
imagine.
and especially even like submarket, right? Like just take a big market like Houston, for example.
Yeah.
There's maybe a couple dozen submarkets of
Yeah.
that, and you break
Yeah.
down the data from that. Again, Yardi or CoStar are a couple great sources for rent level data there. But, you need to compare yourself with a comparable property across the street. That's how you baseline your rents. With residential properties, it's a little bit, I guess you could go on Zillow and you kind of baseline what people are. It's a little bit more fragmented, which is why we like commercial apartments, because the data is out there, and the price fluctuations from one apartment to another, even though they're slightly different, don't really change too much.
Right. Amazing. So like, for that listener who's listening to this, who has a handful of residential units, who wants to scale their game, scale their mindset, what piece of advice would you offer them based on experience?
Stop being an investor, start being a landlord. Or actually, I got it wrong. Stop being a landlord, be an investor. I think, that's why they should go read my book, The Wealth Elevator. The first floor of the Wealth Elevator is, getting yourself up to an accredited investor status, buying a handful of rental properties. I had 11, but it's critical that you pivot and get out of that and get to more scalable investments that, more importantly, are now doing value adds. You're seeing bigger pops of appreciation there. Also, a little bit better tax benefits by using cost segregations and bonus depreciation there too. If not, you're always going to be the first person who gets sued, and you're always the one who's going to be having to essentially swing the hammer or manage the person swinging the hammer. It's just not scalable. But that's what we do within our community. Our community is a bunch of accredited investors, and they're trying to get to that level where they're trying to emulate a family office. Most people are not there yet, right? But I think if I'm kind of in that situation where I'm kind of taking people through the growing pains of eventually having a in-house CPA or CFO or chief legal officer. Maybe they even bring in an investment officer, right? This is more the tail end of their life, because it typically takes a full lifetime to get to family office level. But what I do is I take the first generation multimillionaires and trying to get them to 5-10 mil. And that's what we kind of talk about in the book, The Wealth Elevator.
Amazing. And so if anyone, who's listening to this episode wants to reach out, wants to get more information on your programs and offerings and work with you or even invest with you, how could they get in touch with you?
Yeah, they can, if you're an accredited investor, shoot me an email, lane@thewealthelevator.com. On my website, thewealthelevator.com/syndication, we've got a due diligence guide on you can look at these deals. So it goes a little bit more into depth into what exactly you're looking at when you get thrown a pitch deck your way on the best multifamily apartment deal you ever seen. I think that's the hard thing. A lot of people, this is me in 2015, 16. I got slapped a syndicated deal and I didn't know what to look at, right? I just look at the pretty pictures. That's I don't know any better, right? But as with everything, you have to keep progressing, right? Keep progressing up the floors of the wealth elevator, educating yourself on what you should look at. And, in reality, like a lot of the things that we do today, the underwriting, the due diligence, a lot of stuff that, a lot of people will be doing for outsourced family office or bigger institutional firm. It's not something you can't learn. In fact, some of this stuff you can actually learn in college, which is surprising. Unless you have exposure to it, or you get around a peer community. This is why we do retreats here in Hawaii for our folks. You kind of just stay swinging the hammer, or Mr. and Mrs. Landlord.
Yeah, exactly. And it's, definitely. And, like you said it before, right? Shift from a landlord to an investor mindset. And they're two different mindsets, right? Like the landlord is the one who's thinking about going in there and swinging the hammer, right? And trying to save a few dollars, whereas the investor is not thinking about that at all. It's all about numbers. So great. So, thanks for sitting down with me, today and talking about this really awesome episode. I'm glad you got to sit down with us. And for anyone who's watching, be sure to like, comment, follow, or subscribe, whether you're watching on Apple Podcasts, Spotify, or even our YouTube channel. Lane, once again, thanks, man, for sitting down with me, and hope to catch up in the future.
Yeah, thanks for having me.
Take care, guys.